Hi everyone. FinTech, friend or foe? 3 myths about fintechs disrupting banks. Back in 2016, the story was banks are facing a Kodak moment. And I'm not talking about a picture-worthy type of moment, but rather a blockbuster kind of moment. Remember those? It was all about how fintechs are making a kill on banks, unless banks took extraordinary Herculean efforts on their digital front. It was a very kill or be killed sort of tale. Come 2018, the story transformed into one of collaboration. Today, I wanted to share with you a few myths and common misconceptions around fintechs disrupting banks. Starting with myth number 1, fintechs are eating banks for lunch. And not just the bank's lunch, but the very banks themselves. Take lending, for example. Lending has been and will most likely remain the bread and butter of banks. Yet, in terms of their digital innovation efforts, it has largely been directed towards customer experience and early touch points like digital wallets, P2P payments, and customer service, think chatbots. When it comes to the core competency and its innovation, lending, banks have stumbled. And these missed opportunities have led to an influx of players coming into a space that banks once dominated. It's true, banks have been losing market share to more agile fintech players. The likes of Alibaba, Amazon, and eBay are all capitalizing on small business lending. Amazon alone has made more than $3 billion in loans ranging from $1,000 to $250,000 to small businesses in less than a decade's time. Even payment processors like Square, iZettle, and PayPal are encroaching on the bank's turf. PayPal Working Capital, which debuted in 2013, has since provided more than 115,000 businesses around the world with over $3 billion in financing. But, citing a reputable source, according to calculations done by the World Bank, $2.6 trillion is the addressable market size for SME financing alone. So it's fairly safe to say that fintech players are only scratching the surface. Banks are still at a significant advantage when it comes to lending, not only in terms of cost of capital, but also when you consider the sheer amount of data that banks have at their fingertips and are continuing to generate on a daily basis. Consider one of our bank partners. A large Tier 1 global bank has over 10 petabytes of data. That's equivalent to 500,000 days worth of real-time transaction data. To better put this in perspective, that's about 200 million 4-drawer filing cabinets stuffed with paperwork. We've all heard it before. Data is a new asset class. But data has very little value unless it can lead to actionable insights. And that's where AI and machine learning can make a huge impact. As UBS's white paper on AI suggests, banks face huge challenges in making sense of their legacy data and overcoming data silos and data graveyards, the place where data goes to die. McKinsey further highlights the growing importance of strong data management and how banks need to digitize their credit processes in order to remain competitive. While data management is a step, the biggest stride towards unlocking the true value of data lies in its transformation. The application of AI is especially relevant when it comes to credit decisioning. Flowcast, for example, has partnered with banks to harness their underutilized data and combine it with our proprietary alternative data sources to lead to powerful, actionable insights for credit decisioning. Which leads me to myth number 2, banks are the preeminent authority in credit risk assessment. Banks feel that they can't be materially challenged when it comes to credit underwriting for the basic reason that they've been doing it for a very long time. And it's precisely this sort of mentality that leads to complacency and truly being disrupted. Ironically enough, one of banks' most challenging tasks is actually assessing credit risk. especially for customers with thin files like SMEs. SMEs often can't produce the depth of data needed for banks to make well-informed credit decisions. That problem is coupled with the fact that traditional credit scoring is static, one-dimensional, and linear, which only adds to the problem. And there is a problem. 75% of all SME applications are rejected. This is a direct result of a bank's systemic shortcomings when it comes to credit assessment. Considering 38% of those are actually fundable, that leaves $540 billion of financeable opportunity that banks are leaving on the table. Digital innovations such as AI and machine learning can help to close this financing gap. Machine learning transforms existing fragmented data and combines it with alternative data sources to achieve deeper data analysis. Sorry, that's a lot of data in one sentence. While I don't believe such alternative data can replace traditional credit data, it has been proven that such distinct data sets enhances credit assessment that is powerful enough to bridge the gap for the unbanked and underbanked. Because machine learning allows for better risk separation, it has the ability to uncover many of today's credit invisible SMEs that banks are overlooking. Now, we know how much banks don't like to leave money on the table, so what's the holdup? Which takes me to the third and last point I wanted to share with you. AI is a black box. The rise of complex machine learning model makes explainability key in AI and its adoption. In lending, there are regulatory requirements to be able to explain in human terms why certain decisions were reached. The ability to explain the predictive output is equally important to the accuracy of the prediction itself. However, given the complexity of non-parametric machine learning models, it's often difficult to uncover the features that explain the prediction. People fear what they don't know, but here comes a shameless plug. What if we can tell you Flowcast has developed a solution that can explain the black box? Over the past year, we've spent a lot of time with banks, credit risk, and model validation teams to prove that we can, in fact, make a black box transparent and further transform that into actionable insights that drive business. Our models analyze thousands of data points and, most importantly, are able to surface the factors that lead to a prediction. Some of these factors may include country of domicile, industry, currency of transaction, and season. Because we're able to surface the factors that goes behind a prediction, that in turn enables banks to proactively optimize their lending portfolio. For example, if a bank can identify which customers are based in a certain country, in a particular industry, and are headed toward a seasonally soft period, they can adjust the credit limits of exposure accordingly. Now, what's my point? I don't think fintechs and banks should be pitted against one another. Fintechs are great at innovating, and banks are great at lending. When the two are able to focus on their respective core competencies, the outcome is powerful. The benefits of AI and machine learning have been proven. It's no longer an exploratory POC stage. And banks are well positioned to adopt AI technology given the breadth, depth, and velocity at which data is being created. However, like I mentioned before, to gain any value from data requires a tremendous amount of data transformation, which in itself is no easy feat. The reality of digital innovations like AI creates an opportunity for banks and fintechs to collaborate rather than fight for dominance, especially because speed to market is critical. If you'd like to learn more, feel free to come see me after. We've written a white paper on how we've collaborated with banks and are also in the process of fundraising. Thank you very much for your time.